Nothing is breaking. That's the problem. When systems fail, they usually don't scream first. They whisper stability. Prices move, but not too much. Losses appear, then disappear. Bad news lands, then gets absorbed. It feels like control. It's actually a lull before leverage finishes its sentence. This matters now because calm has been engineered into the market. Every dip is met with a response. Rates get nudged lower. Liquidity gets released. Programs get announced. The story repeats often enough that it stops feeling like policy and starts feeling like physics. Here's how the comfort zone is built. A shock hits the system. Prices slide. Stress shows up in one corner. Then the backstops arrive. Central banks loosen. Governments spend. Big institutions reposition. The fall slows. The bounce arrives. The first time, it feels like rescue. The second time, relief. By the fifth time, it feels like a rule. Behavior adapts. Traders stop flinching at bad headlines. Lenders stop pricing uncertainty like a threat. Investors stop asking how deep the floor is and start asking how fast it rises. Risk doesn't go away, it gets rebranded as timing. On the surface, the system looks more mature. Crashes are shorter. Volatility is smoother. Drawdowns look manageable. The market appears to have learned restraint. Underneath, the math is drifting. If losses recover quickly, positions grow. If support arrives reliably, leverage expands. If rescues feel routine, margins for error shrink. The same strategies crowd into the same narrow trades. Returns look stable because the assumptions behind them are shared. Correlation hides in plain sight. The room fills up quietly. Publicly, this is framed as resilience. We point to rebounds and call them proof. We point to stability and call it progress. We call it a smarter system. Privately, the system is balancing on belief. It works only if timing holds. It works only if support arrives before stress spreads. It works only if confidence doesn't crack when it's needed most. That belief changes incentives. When pain is postponed often enough, people stop budgeting for it. Buffers thin out. Contingencies become optional. The cost of protection looks wasteful. Small shocks fade too fast to teach anything. Warnings sound like pessimism. Pressure migrates into the blind spots. Complexity stacks on top of complexity, each layer assuming the one below it will hold. Then the system meets a shock that doesn't fit the script. Support is late, or smaller than expected, or politically blocked, or aimed at the wrong pressure point. And the drop isn't gradual, it's sudden, because the structure above the comfort zone was built on the idea that the floor would always move up to meet it. So the real danger isn't that markets feel calm, it's that calm has become a dependency. And dependencies feel safe right up until they're tested.